Most rideshare and delivery drivers believe they're making money. They see gross pay, $800, $1,000, sometimes more per week, and assume they're earning income. But after mileage and time are accounted for, many drivers are actually paying to work without realizing it. And under federal labor and tax law, when workers operate at a loss while companies control compensation, that can become misclassification and wage theft. Every mile you drive destroys your vehicle. Fuel, maintenance, depreciation, tires, insurance, it all adds up. The IRS already calculated this nationwide cost. In 2026, the standard mileage rate is 72.5 cents per mile. That number represents the average real operating cost of using a personal vehicle for business. So mileage is not optional math. It is the federal government's baseline measurement of economic reality. I encountered a driver whose 2025 earnings looked profitable at first glance. Gross earnings, $4,700, miles driven, 10,241, vehicle cost, $7,168.70, before even counting time. That driver was actually $2,467 in losses, meaning they drove thousands of miles, spent their own vehicle's equity, and effectively worked for free while losing money. And that does not yet include unpaid labor time. Here's the part most drivers are never told. Independent contractor status does not allow companies to pay workers whatever they want. Federal agencies evaluate classification using what's called the economics realities tests, applied by the IRS, the U.S. Department of Labor, and the National Labor Relations Board. If workers depend on a company, lack real pay control, incur losses, and operate under company direction, then classification can legally change regardless of what a contract says. Misclassification becomes both wage theft and tax distortion because standard taxable wages are never actually achieved. Profit and control. Drivers often earn less than standard wages after expenses. Apps determine pricing. Drivers cannot negotiate fares. Income depends entirely on algorithm decisions. Drivers respond by driving more hours after pay cuts. Investment. Drivers provide the vehicle, fuel, maintenance, insurance. While platforms carry minimal trip-level risk, drivers may incur direct financial losses. Permanency. High turnover exists alongside long-term dependence. Many drivers remain because alternative income is limited. Behavioral control. Apps influence behavior through acceptance rate penalties, trip detail restrictions, incentives, unpaid waiting, reservation arrival requirements, and logarithmic deactivations. Drivers can be removed without meaningful dispute processes. The relationship to the business. Drivers are integral to the platform. Without drivers, the service does not exist. Skill and initiative. Low barrier entry. License, clean record, vehicle. Workers are easily replaceable, creating oversupply pressure. Drivers frequently accept trips near $1 a mile or less, but subtract the IRS standard mileage rate. $1 subtract the 72.5 cents is 27.5 cents remaining. That remainder must compensate for all working time. At common urban speeds of 3 minutes per mile, drivers approach minimum wage or below before taxes. Many drivers unknowingly accept low pay, specifically because reduced taxable income feels beneficial. But operating tax-free often means operating profit-free. Here's where rideshare economics become inverted. Taxis earn more as speed increases. TNC rideshare, drivers often earn less. Lower pay per mile forces longer driving time, greater mileage exposure, and increased vehicle depreciation. Drivers subsidize low passenger prices using personal assets. California's Prop 22 guarantees 120% times minimum wage for active time, plus 37 cents per mile, but only during engaged trips. Waiting time, dead miles, early arrivals, and repositioning labor remain unpaid. Weekly adjustments create the appearance of protection while allowing below guarantee trip pricing. This floor becomes mistaken for fair compensation. Here's an example. 97 miles driven, the IRS value is $76. The time worked is an hour and 46 minutes, times local minimum wage is about $31. Total labor value, $101. Actual gross received, $59.95. The result is a negative economic outcome, round-trip losses deepen further, and this represents paying to provide labor. In Portland, around 2015, drivers averaged $37.50 to $76.50 an hour plus the mileage equivalent. That equaled roughly 4 times to 8 times minimum wage, on top of the standard mileage rate. By 2026, many drivers average near $13 to $14 an hour equivalent profit before tax, below local minimum wage levels. Compensation declined while operational control increased. This model works because drivers are fragmented, calculations are complex, and gross earnings obscure true profit. Lower driver earnings subsidize rider pricing, increase market share, and support company valuation. This system depends on workers not performing true cost analysis. When taxable profit fails to reach standard wage equivalency after expenses, federal agencies may interpret the relationship as misclassification. Companies face back pay exposure, penalties, classification reassessment, and drivers may file wage claims or seek recovery. A fair system guarantees mileage compensation, time-based earning, fair transparency, driver rate control, and sustainable profit above operating costs. Drivers organizing collectively can establish platforms aligned with these principles. Drivers, advocates, and passengers can raise awareness, share verified calculations, support fair platform development, and participate in organized alternatives. Economic systems change when workers coordinate rather than compete individually. We make choices every day within systems we rarely examine, but when people understand the math behind their labor, they gain power over it. If a business model only functions when workers unknowingly operate at a loss, that is not innovation. It is subsidy. And informed workers can change it.